with the definition, risk to reward, the risk would come down to your maximum drawdown before you exit the trade at a loss. So this would usually represent your stop loss. Reward is your take profit. But here's the thing, right? Let's say, for example, our first trade that we took, we risked $100 and we won $200. Our risk to reward would be a 1 to 2 because whatever we risked, so that amount stays at 1, our potential win, or in this case our win, was double compared to what we risked. If the next 2 trades were to be complete losers, let's imagine that trade 2, again, our risk is 100, so it stays the same. We have a loss. Well, now we're down 100. Well, initially we were up 200 after the first trade, so now we're still technically up $100 despite losing 1 and winning 1. And now for the third trade, let's say the same scenario plays out. It's another loss. We're down $100. Well, now we're back to break even. It pays, in my opinion, to have a risk to reward. Ideally, that's at least a 1-to-1 or better. For most people, unless you're a complete beginner, but even then for most people, a 1-to-2 or a 1-to-3 is very realistic. So that way, if you lose 1 or 2 or even 3 trades in a row, your last winner makes up for that. And in the end, it comes down to sample sizes, meaning how well you did after a certain number of trades, not just 1 or 2, but you can have a sample size of 20. So how well did you do after 20 on average or after 100? Let's say someone took this setup here on Tuesday. Let's say you took this trade and you have a 20 tick stop loss. Only 2 or 3 hours went by and there you go. You hit a 1-to-2 RR. This is quick hindsight analysis. That's not the point. I'm just trying to get the concept across that a 1-to-2 RR, which is, I think, for a lot of people, very realistic, is possible. And that's just based off of this stop loss here. Even if you don't have the best entry, in this case, you could probably get away with a slightly tighter stop loss and a slightly greater take profit, especially if the trend is there and you can hit a 1-to-3. But here's the thing, you don't want a stop loss that's too narrow because it seems like, oh, well, I'm just going to set my risk to reward to a 1-to-10. But the issue is you're probably going to get stopped out a lot if it's way too tight. And so unless you're playing the game of where you're constantly re-entering after getting stopped out, which psychologically most people are not going to be good with, then your best bet, I think, is to stick to like a 1-to-2 or a 1-to-3 or even a 1-to-1 in the beginning until you just get in the habit of that. And that's the beauty behind using a good risk to reward ratio for your setups, is that your win percentage, you can get away with being under 50%. Now, if it's 10%, 20%, you just have to work on your trade setups. You're probably taking bad setups in general, or you're too trigger happy and just entering and closing way too fast. Let's say you take normal setups. In this example, where this is a very, very small sample size, here we have 1 win and 2 losses. So you have more losses compared to wins, and yet there's still break even here. Let's say you took 4 trades in total, 1 loss, second loss, third loss, you're down 300, but now you're up 400. Why? Just because of this one trade. This one trade where you won 400, despite having these 3 consecutive losses in a row. And they don't have to be consecutive as long as they're more, you can have more losses compared to wins. This trader here would still be up $100. They would still be profitable, right? Even if you make something like 5% per week or 10%, that's amazing. That's incredible. That's something to be very proud of. Don't listen to the marketers and all that noise online that's telling you to aim for 50, 100% per day. That's ridiculous. And usually it's just gambling and it doesn't work out. Only works short term, but doesn't work long term. Even though your win percentage is 25%, this is still pretty good. And again, just for an example, because this is a pet peeve of mine when I see this, let's assume the first trader, they took a trade and they risked $100, meaning if the price hits their stop loss, they're down 100. But luckily for them, it works out and they make $400, right? They closed 100% of their initial position at their take profit of $400. So they actually have a successful risk to reward of 1-to-4, right? It counts as a 1-to-4, because they checked off 100%. But now trader B, that's where we have these two setups here. So just imagine this is playing out over here, but on the left, let's assume it's the same exact setup. So they have the same stop loss. So just focus on this upper portion. Let's say they're risking $100, same as trader A, except this time they close 50% of their position halfway. So because they closed it halfway, if they were to close 100% of their position, well, obviously they would only make $200, right? Because if you are able to hit a 1 to 4, 100%, that's 400. You hit a 1 to 2, that's 200. In this case, if it were 100% of their position, they'd be up 200, but they closed 50%. So you got to cut that in half. And now the second position is running. So this is the only position left. So let's assume this isn't playing out anymore. So they're up 100 and the trade is continuing to run. It's continuing to run. And then finally they hit their second take profit target. Now, why isn't it $400 like the first trader? Didn't they have their take profit set at the same spot? And yes, that is true. They have their take profit at the same exact level. However, because they closed 50% of their position earlier, they're only going to profit 50% or half as much as they would compared to closing 100% down here. So they're not making 400 for their second position, they're making 200. So at the end of all of this, these are both successful, profitable traders. And I'm not saying you shouldn't do partial profits. I love taking partial take profits and I have runners too. But notice how the first guy or gal, they took a $400 profit, whereas the second trader only took $300. So that is pretty much the trade-off here, is that sometimes if you do partials, especially too quickly, you're not going to profit as much as if you were to hold on to the whole position. But again, that is a risk in itself, because if you hold on to the whole position size, then that is also a gamble because that might not hit right away. The whole point of this, the whole tangent that I just went on, is to just cover a pet peeve of mine of explaining why Trader B's scenario does not make his setup a 1 to 4 risk to reward, because they are not closing 100% of their position. They're doing partials. It's just funny when I see this online, because you will have some traders who will, I'm not naming anyone, but they'll claim that they hit a 1 to 10 or a 1 to 20 RR, and then you see that they closed majority of their position halfway or a lot earlier. Now, ideally, you should aim for at least like a 40, 50, 60, 70% win percentage. I think it's a lot easier just because in the end, you have to include taxes and fees, and plus you're not always going to hit a 1 to 4. Sometimes certain weeks you're going to get slightly less, but even just going for a 1 to 2 or 1 to 3 and having a win percentage of, let's say, 35%, 50%, that's typically more than enough for most people. And that is the significance of trading with a good risk to reward ratio, which I think is super powerful. So definitely take advantage of that. And yeah, drop a comment down on what topic I should cover next. And that's all for this one.